But let's move on. And the RBI has released its financial stability report, saying that Indian financial system remains resilient with healthy balance sheets amid the elevated global uncertainties. Bad loans are expected to stay near multi-decade lows, and banks have adequate capital buffers even under adverse scenarios that are going on right now. Latha is joining in with us to give us more details on this report. Latha, good morning.
Good morning. One way to summarize is that it is global risk but domestic bliss. That seems to be the message. Globally, both the global economy and the financial system are seeing elevated risks from economic policy and trade policies. As we know, the financial markets are also volatile, especially the bond market, the report points out. And then there are the old vulnerabilities, which is, too much public debt. Look at the fiscal deficit of the US, China, Europe. So the old problems remain, new problems in terms of trade wars have come, and all this can amplify asset quality shocks. But in this ecosystem, the Indian economy stands as a beacon of resilience. It's actually a key contributor to global growth itself, since it's one of the largest growing economies. As well, it is underpinned by strong macros. The balance sheets of banks, NBFCs and corporates are very clean, as the report points out. And the stress tests on mutual funds and clearing corporations also show that stress is low. The insurance regulator points out that consolidated solvency ratio of insurance companies remains above the minimum thresholds that are required. So all aspects of the financial sector are good. Remember, the FSR is actually a comment on financial institutions, so it delves a little deeper into banks. Status of banks, gross bad loans and net bad loans are both at multi-decadal lows. Gross NPAs at 2.3%, lowest ever, and net NPAs at 0.7%, again, lowest ever in many, many decades, or probably the lowest ever. Credit growth is the problem. That was down to 11% as of March, and they expect as of mid-June, it has fallen to 9.6%. So the worry is growth, not asset quality. And for the first time, PSU banks' credit growth is faster than private banks, the report points out. Then the FSR normally builds stress scenarios. If you build a stress scenario in the baseline, the gross NPAs of banks doesn't rise at much, 2.3 to 2.5. So what it is telling you is that this 2.3 is the best. Even as a baseline, it is going to rise to 2.5 in the next 2 years, March 2027. But in adverse scenarios, it can grow more. I'll come to that. The baseline capital adequacy also dips in the baseline, and CET, which is equity, common shareholder capital, that actually rises in the next 2 years because of retained profits of banks. But in adverse scenarios, things will be different. The GNPA goes up to 5.6 and 5.2, and capital adequacy also dips. These are the adverse scenarios that the Reserve Bank builds to stress test the banks. On NBFCs, again, the GNPA is very good. Gross NPAs are at multi-decadal lows of 2.9%. Again, if you apply the risk, baseline itself, it rises to 3.3. Now, this is important. As of March 2025, 2.9 is a multi-decadal low, but it is going to rise to 3.3 according to the RBI. In adverse scenarios, it rises more. Then again, capital adequacy at the moment is 23.4. It may dip to 21.4 by the time you come to March 2026. And credit growth, again, for NBFCs also weakened. It weakened for most sectors. It weakened most for unsecured loans, and for MFIs, that is microfinance, it contracted.
Okay, Latha, thank you so much for that. But